This week on Wealth Track, the hunt for big investment gains in out-of-the-way places. Two global money managers, Ariel Investments stock star Rupal Bhansali and a Loomis sales bond leader, David Raleigh, travel off the beaten path to find hidden winners. Next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. How do you feel about your portfolio this year? Well, if you are similar to the vast majority of investors, you are probably leery of stocks, resigned to bonds, and grateful for anything yielding more than the 2.5% or less offered on 10-year Treasury notes. In fact, the trend away from stocks and into bonds has grown more pronounced since the 2008 financial crisis. As this chart from innovative research firm Strategas shows, net inflows into bond mutual funds have accelerated in recent years, whereas stock mutual funds have seen quickening outflows. It is a stunning divergence. Do these gigantic shifts still make sense? Well, stocks have had a remarkably good year. The S&P 500 is up double digits, as is the NASDAQ and major European and emerging market indices. Meanwhile, there is huge divergence in bond performance. 10-year Treasuries have lagged significantly, but high-yield bonds have delivered equity-like returns, as have emerging market issues. So where in the world should you look for opportunities in 2013? Two global investors are joining us this week, both with excellent track records, one in stocks and one in bonds, and both are new to Wealth Track. Rupal Bhansali is a star global stock manager who is now the Chief Investment Officer of International Equities at Ariel Investments and Portfolio Manager of Ariel International Equity and Ariel Global Equity Funds. Bhansali spent a decade at Mackay Shields, where she ran a top decile, 5-star rated international equity fund. David Raleigh is co-head of the Global Fixed Income Group at Loomis Sales and co-portfolio manager of the Loomis Sales Global Bond Fund, Loomis Sales International Bond, and Global Equity and Income Funds. Over the years, David and his team have been recognized as best in their categories by Morningstar and Lipper. I began the interview by asking them what surprised them the most in the markets in 2012.
Markets always surprise, but I think the surprise for everybody in 2012 was that developed markets, equity markets in Europe and the US outperformed by a mile emerging markets. You know, the inflows into mutual funds have all been into EM, and to think that DM would shoot the lights out compared to EM, I think was the biggest surprise.
That is a big surprise when you look back. Dave, from your perspective as a global bond fund manager.
I think one of the reasons why that might have happened is my surprise, which was how little volatility we had. I mean, after August and September of 2011, a lot of people went into 2012 prepared for essentially more bad news from Europe, and in fact, Europe really was not the big problem for investors. It was a low volatility year, and a low volatility year is not what people were looking for.
So that risk on, risk off trade that we all, kept reading about and talking about and everything else, refresh my memory, that didn't really happen this year?
It was really muted. I'd say we certainly had risk on in January and February. All
right.
Markets rallied, particularly, importantly, risk markets, with the liquidity from the European Central Bank that began about this time a year ago, and they did more of it in February. The only thing we had that really looked much like a sell-off was a bit of a pullback in May, and it was not nearly as bad as the previous year.
Except right after the election we had, but then since then it's been fine. So what about 2013? We've just got a little bit of time left in this year. So what are you planning for, Rupal, in 2013?
I think that the markets in general have gone up a lot. And so next year and many years going forward, I think it's going to be about choosing and selecting alpha rather than relying on beta to get your performance. So stock
and
picking.
explain for our viewers the difference between alpha and beta.
Sure. Beta is something where the asset class itself, just by being long the asset class, you can get your returns because it's just undervalued across the spectrum.
Right. So
but now
the
that
market's going
that's right,
up.
the whole market
Right.
goes up and you just go up with the tide. I think that given the valuations in the market, I think stock picking, so cherry picking your exposures, being in particular parts of the market rather than the entire market, is what's going to serve you well in 2013. And that's how we are positioning. We're looking specifically for those portions of the market where you can get the best combination of growth and value, because both are very important to improve the risk reward of an investment proposition, which is kind of our mantra. We don't look just for return management, we look for good risk management.
And what about in the bond market? And I'm thinking the bond market, which of course everyone has been saying for years that bonds are really expensive, and especially sell treasuries. They're the most risky investment you can possibly buy. So what are you expecting for 2013?
Well, I'm hoping that we have a sideways market in 2013, but I'd have to agree with your comment. And this is embarrassing. If I just say, well, gee, interest rates are really low now, I'm thinking, wow, that's an expert remark, isn't it? I mean, you get nothing if you hold cash, and you don't get very much if you hold 2-year or 5-year treasuries. You get 1.6%, something like that, if you hold 10-year treasuries. But it's not just the United States. The U.S. Treasury market is expensive, meaning yields are really low.
Right.
But so is sterling, so is the northern half of the Eurozone, so is Japan. And that's 85% of my benchmark. So what I'm hoping to do in 2013 first is protect capital. And then after that, do exactly what Rupal said and replace market risk with specific risk. So in this yield desert, what we're going to be looking for is little oases of positive return, and there are going to be lots of different little things. So no one big theme, lots of small themes.
Talk to me about some of your big themes, the big investment themes that you have.
A lesson and a principle that all investors would be well advised to pay attention to is the following. All good things come to an end. The corollary of that is all bad things come to an end. And in investing, a lot of people tend to own the good things that have happened to them, which is fixed income, for example, and they tend to over-own it. They over-own the portions of the market that have performed very well, like the fixed income proxies, utilities, real estate, the REITs, energy stocks, and so on. We think that good trade has come to an end. And we think some of the bad things that are coming to an end provide an excellent investment opportunity. Patent cliffs in the pharmaceutical sector. We all talked about patent cliffs and generics threat. Well, that's sort of played out over the last decade. But the pharma stocks are extremely cheap now. And frankly, some of the pharmaceutical companies that invest in R&D, which takes 10 to 12 years to fructify, well, the payday is now around the horizon. Take GlaxoSmithKline. They have a lot of drugs in their pipeline that are in phase 3. And you can look forward to both a single-digit to double-digit earnings growth, cash flow growth, and a low valuation of 10 times with a 5-6% dividend yield. So contrary to what you have in the fixed income markets where you have extremely low yield, there are portions of the equity markets where you have very high yield. So I would say that that's where the opportunity is. That's the big theme. All good things coming to an end, all bad things coming to an end. So it's time to reposition the portfolio.
Would you agree that basically that all good things come to an end, and therefore the good place to be has been in the bond market overall for like the last 30 years, and that in fact the best things in the bond market, the best performance in the bond market are behind us now, and that there is going to be some sort of a reversion to the mean, which people have been talking about now for 5 years?
Well, that's a really deep question. It may be the
Not
deepest
sure about
question.
that, but-
It may be the deepest question in fixed income, and let me explain why
Yes.
it's really fairly profound. I believe in reversion to the mean, and so do most investors. But what you have no consensus on is whose mean are we going to revert to? And what I'm really talking about is the difference between traditional American valuation metrics and traditional American levels of interest rates and Japan. If you think about Japan, you had very low interest rates, not for a year or 2 years, but for 20 years.
Right.
20 years. And the question is, are we all becoming Japanese? The United States, I think, will not become Japanese. And I think the reason is that there are no votes in that. I think that the policymakers, particularly the Federal Reserve, is targeting nominal GDP growth. When they talk about what they do, they talk about a dual mandate, unemployment rate on one side, inflation on the other side. You put them together, you're talking about how the economy overall is doing. If you're going to use one number to do that, you look at how the whole economy is growing, not in real terms. That's how it's usually discussed by us and by others, but in nominal terms. That used to be 5 to 6% per year. We're growing at about 4% a year and struggling in nominal terms.
That's GDP growth, what, of 2% and inflation of 2%? Or?
Yeah, GDP growth of 2% on a good quarter and inflation at about 2%. And you add those together, you get that 4% number. And we're throwing everything but the kitchen sink in monetary policy to hold that number up. Well, the problem is the way the Fed throws liquidity at to try and push up nominal GDP. The other name for nominal GDP is our tax base. You see why they want it up. You want a tax base up if you're worried about, trade-offs between cutting back government, transfer payments and government expenditures on the one side, and raising taxes on the other side. The higher the tax base goes up, the easier that trade-off becomes. But the way you do it with quantitative ease is also called yield suppression. Mm-hmm. So the government policy from central banks, and not just ours, but the United Kingdom and others, is to push yields down to try and get nominal GDP up. Well, nominal GDP is my value metric. For 30 years, if I ask what's fair value for a bond yield, I look at nominal GDP trend growth. So if they want it higher, that means that at some point out there is a pretty ugly bond bear market. So ultimately, I'm saying we mean revert to something that looks more American in terms of GDP history and
globally,
less Japanese globally.
Mm-hmm.
Because if we don't, I think the fiscal conversations are just going to be very, very unpleasant.
So you think bonds are really expensive too?
Absolutely.
Correct? Yeah.
Yes. I think that investors have pushed the envelope on this good thing. And again, it's a rear view mirror because they perform so well. There's a lot of money chasing this asset class. And I think what investors are forgetting is they are so afraid of the volatility risk in equities because equities bounce around in double digits too often, and 08, and 2001, 2002 sort of really put the fear of volatility risk. I think people are forgetting that by owning fixed income, you may have less volatility risk, but you have swapped for another form of risk, which is valuation risk, which is the biggest risk of all. Real estate didn't have too much volatility till it fell 30-40%. Right. It's a one-way move down. Right. Exactly. And I think that's sort of what is lulling people into thinking that fixed income is safe because it doesn't fall as much and it doesn't have that much volatility. And I think that's the biggest misnomer in the markets. I'm not such a believer of mean reversion as much as I am of, we have to think for ourselves. So independent thinking is what characterizes Ariel and some of these investment propositions that I'm giving to you. And I think in that construct of independent thinking, looking at portions of the equity market, not the ones that are crowded trades, which everybody wants to flock to, that tends to take the valuations to very unattractive levels. Emerging markets is a classic example where everybody over the last decade has gone into it. It's exactly what happened when people went into technology stocks, TMT, in the late 90s, and they couldn't have enough of it. And then, of course, look at the reaction, on the other side of the fence. Today, I would argue, after 10, 11, 12 years, the technology stocks in the US are some of the cheapest out there. And yet nobody wants to own them. So there is opportunity, there is tremendous opportunity, because a good thing with equities is you can truly pick your spots. You don't even have to have beta, you can have pure alpha. And I have many examples if your viewers care.
No, I think we do care. And so, one of the things that you had told me is that, as far as the, all good things must come to an end, that Apple is an example of all good things must come into an end, and all bad things must come to an end, that Microsoft is, so that's a classic example in the technology sector. You would sell Apple stock and buy Microsoft? Is that essentially a trade that you would make, or?
When we make any investment decision, we weigh, and I suggest all investors do this, not just the reward or the returns they expect from the investment opportunity, but the risk they take. So the downside that you can expose yourself to with that investment as well. When I look at Apple, when the stock is in the 500s, give or take, because it's been up and down now, and it's got a market cap of close to $500 billion. For me to think that I'm going to get 30-35% upside in Apple means the market cap has to go to $800 billion. Never happened in the history of the world, by the way. So now you're expecting something that is excruciatingly challenging, even against the odds, right? On the other hand, can I think that Apple could go down 25-30% from here? Absolutely. Because there are lots of things that it can have a challenge in succeeding in. Then you take Microsoft, a stock that is already derated so much to the point of being on 6 times X cash, 9 times, with the cash, excluding the cash, earnings. This is a company that generates billions and billions and billions of free cash flows here and now, and that's the multiple you have to pay. It's like a 15% free cash flow yield. You can easily see the stock going up 35-40%. And it's extremely hard to see why it would go down 10%. So you've got the odds risk reward, 3:1, 4:1. And this is a mainstream blue chip company you can have in your portfolio and clip a coupon of 3.5%. Well above the 10-year bond rates of most markets out there.
All right. And, David, speaking of independent thinking, Loomis Sayles is also known for being an independent thinker. And one of the things that you told me is, first do no harm. So where are the kind of the niches, the special places that you're looking at Loomis Sayles, especially considering that there could be tremendous harm if, and I don't know when, but if the bond market does implode?
Well, as we look at the fixed income landscape right now, we're driven to certain strategies through almost a process of elimination.
Mm-hmm. Oh.
Now, if we hold very short maturity securities in good companies, we get paid relatively little,
right,
as approximating nothing. And so cash type substitutes do not appeal. It's a liquidity reserve. It's not an investment return idea. But at the same time, given that I think that the overall level of interest rates has been artificially suppressed by policy and someday will adjust, I don't want to own 30-year paper because those would be where you have your biggest capital losses. At least I don't want to own 30-year paper unless I'm getting paid 7 or 8% to do it. You can find some of those.
Really?
So if I'm not going to be taking a lot of market risk, it comes back to specific risks.
Right.
There are things we don't like, and many of them maybe the same companies that Rupal does like. Let's take, say, GlaxoSmithKline. Now, if their dividend is between 5 and 6%, that's an interesting equity dividend. But if Glaxo came to the bond market and wanted to borrow $1 billion, they wouldn't pay investors anything like 5 or 6%. It would probably be more like 2 something. So 2% in the bond, 5% in the stock. If you think in 5 years' time Glaxo's a bigger and more successful company, you prefer the equity.
Right.
Having said that,
you go with Rupal.
Right. But having said that, you can find parts of the bond market that can return that 35%. Let me give you an example. In Europe, you can find good quality companies that have really been beaten down. Some of them are big, large cap utilities.
So are you talking about stocks have been beaten down, or the bonds?
We're talking about the bonds.
The bonds.
The bonds
okay.
have been beaten. The stocks have been beaten down too in some cases, but in many cases the bonds have been beaten down. So you can look at big companies, and we're talking about like the phone companies and the power companies of places like Italy, Spain, Portugal, France, Veolia. Was one of the best performing things in my portfolio. Why? The people were worried about the euro stuff. They drove their long bonds down to 86. The other day they were 118. Well, that's, 86 to 118 on par is a pretty good return. And so it's still possible to find securities in the fixed income markets that can return 30 to 40%. It doesn't seem like that would be possible, but if you can buy them at 85, and sell them at 118, that's a good day.
So, that's another issue. So are you finding, when I'm hearing that kind of appreciation, is it time to sell these issues? I mean, are there a lot of your portfolio that looks overvalued that you've really got to start thinking
Where
of
we
putting
find
somewhere else?
bonds that have had tremendous performance and now trading at a substantial premium to par, we're more likely to be sellers than buyers.
Right.
We are buying more new issues, coming at close to 100 than might be normal for us. Our preference is to buy good quality companies at a discount to par in the secondary market. yields are so low that there's not that many discounts around right now. So we are using more new issues, but we're still finding islands of opportunity. One of the places we're finding it, and here I'm going to go maybe in a different direction from what Rupal said about emerging markets, is in emerging market corporates. Many of them are coming to market for the first time in the bond markets. They have never been issuers before, and so to access global capital, they're prepared to pay a new issuer premium, sort of just, we'll pay you a little extra compared to our rating, compared to our cash flows, so that you will look at us and consider us. Many of them are emerging market banks. They've never had to access the bond market before. They could get cheaper funding from other banks in the developed world. But if you think about the stress that American banks have gone through, that European banks are continuing to go through, well, the price of a term loan from a French bank is different from what it used to be in 2007. And they now look at the bond market and say, well, you know, 5-year dollar pay paper, maybe we should do some of this. So you've seen a lot of emerging market banks. And we're talking about folks that in that country's market are blue chip.
Oh, the blue chips.
You know, top 2, top 3 banks in their local neighborhoods. So the people there think this is a terrific bank. But the people that don't live there may not know them so well. You can find actually very interesting yields with that kind of an opportunity, or other companies in other industries that are looking to grow out of their local footprint, become true multinationals, and just need the funding.
It's interesting. Every security-specific portions of the market he referenced that he's finding value and opportunity in the bond markets, which is the utilities and telecoms in Europe and the banking sector in emerging markets, etc., are exactly the portions of the market that I would not own in the equity markets. And we think that those sectors have significant challenges, and actually the equities are quite overvalued despite the correction. So I think that what it boils down to for any investor is to have a combination of what he can do for their portfolios and what I can do for the portfolios. And the fact of the matter, it sounds like we'd be pretty diversified because we're not making the same bets.
You know, this is a balanced portfolio.
Let's talk about that equity. What might be bad for Rupal's returns if she buys a stock in an emerging market might be good for me. I'm a bond investor, and that I am senior to that equity. The bigger the market cap of that firm, the more cushion of value there is underneath me, and the more that has to be eliminated before I don't get paid, before I don't receive my coupon on my principal back. So an overvalued stock market is not necessarily bad news for a bond investor.
So I need to switch gears here because we're almost running out of time. I can't believe that we are. This is so much fun. So Rupal, with the one investment for a long-term diversified portfolio, what should we own some of in a diversified long-term portfolio?
This will prove to be a very contrarian, possibly controversial idea for people, but that's exactly what we at Ariel do. We try to pick the best investment ideas before the market discovers it. So here I go.
So we could be early,
Yes. I would say that the biggest mistake people are making in their portfolios today is not owning Japanese multinational companies. You know, everybody wants to own emerging markets. Japan is viewed as a submerging market. I think that's where you go because some of these Japanese multinationals, Toyota, Nintendo, Canon, and I can give you a string of names like that. I don't mean Japan, the domestic stocks, but I mean the multinationals. I think they have extremely good products. They're very competitive, and they have the global marketplace as their opportunity. So no matter what happens to Japan, they will sell their wares in overseas markets.
And they're undervalued
and they're very undervalued. You get 4 or 5% dividend yields in a stock like a Canon. I mean, this is unheard of in Japanese markets. They've corrected 75% from the peak, while the US market of the same period, about the last 25 years, is up 500%. Japan is down 75%. Enough is enough. All good things will come to an end. All bad things will come to an end.
Very intriguing idea. Dave, what would your recommendation be?
I think that the 2 fixed income ideas that probably will not break your heart over the next year would be emerging market corporate debt, which I talked about, and to go domestically, bank loan portfolios, but that are actively managed. And again, now you're at the top of the capital structure, and you have a decent yield. We're talking about flow income of over 4%. So that's in a dangerous fixed income landscape. That's a relatively safe place to be.
Well, thank you both very much. I feel, as we kind of close the year and we're heading into Christmas and the holiday season, I think, you've both given us some terrific investment gifts. So I really appreciate your being here on Wealth Track. Rupal Bhansali, it's great to meet you here and finally have you on Wealth Track. And Dave Brawley, I've seen you in many conferences. I'm glad to finally have you on Wealth Track as well. So thanks for joining us.
Likewise.
And happy holidays.
Thank you very much.
As we close out this edition of Wealth Track, we want to share some holiday gift suggestions with you as well. There have been several excellent business/investment books published this year that our financial thought leaders and others have recommended. They might be worth putting under your tree. I know I want them under mine. Hint, hint. One is Walter Isaacson's biography, Steve Jobs. Everyone I know who has read it has been mesmerized. And as Mae West used to say, goodness had nothing to do with it. Another much-mentioned favorite among investment pros is The Signal and the Noise by Nate Silver, a now famous political analyst who tackles the art of prediction and his thoughtful approach to it in a wide range of areas, from economics to terrorism to weather, baseball, and the markets. Finally, behavioral economics is making more and more sense. Who better than Nobel laureate Daniel Kahneman and his new book, Thinking, Fast and Slow, to help us understand how we think, react, and make decisions in all phases of life, including investing. I am looking forward to reading all three. And of course, check out our Wealth Track bookshelf with books we and our guests have already read, and in some cases authored, on our website, wealthtrack.com. Speaking of which, in the next couple of weeks, we will be upgrading our website and adding more content and features from our exceptional guests and sources. We look forward to your comments and suggestions as we roll it out. And that concludes this edition of Wealth Track. Thank you so much for watching. Have a Merry Christmas and make the week ahead a joyous, profitable, and productive one. Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value.